Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today I'm ripping through the comment section and I'm reading some of your guys' comments and questions, and I like to answer these to help you guys out. Again, this is just my financial opinion. It's nothing more than just my opinion. So here it is. Why do you favor highly leveraged companies? And when I talk about highly leveraged companies, it's usually in oil and natural gas. So what happens is, and why I prefer investing in them, is when the ratio, I'll start with the ratio because that's value. When the oil to gold ratio gets cheap, we got to ridiculous levels, like over 50 to 1. That's 50 barrels of oil to 1 ounce gold. A very cheap ratio is 30 to 1. 50 is ridiculous. A very expensive ratio is only 10 or 8 barrels of oil to 1 ounce of gold. And I always talk about gold. Gold is just an accounting mechanism for money. It's an accounting mechanism for how much money is in the system. And it only accounts for the money system when we're in an inflationary period under real negative rates. It doesn't do it at any other time. It's just what history has shown us. So it accounts for the money supply in a real negative rate environment, and when people are flowing money into it. They sell bonds, they sell stocks, and they flow it into gold. Now, the reason I like highly leveraged companies, so if the valuation is good, when oil falls way down in relationship to oil, and we get one of these ratios that is a 30 to 1 or greater, I like the highly leveraged ones because they're usually high debt and a high cost producer. The company has a likelihood of potentially going bankrupt. And because it's potentially going bankrupt, everyone sells it. And at the bottom, when you have this ratio that's bottomed and starting to come back up, everyone sold that stock. So you can buy it for literally 1 penny for the dollar. So it's pennies on the dollar. Everyone's sold it. They think it's going to go bankrupt. They got a ton of short sellers are in it. And what I do is I take the opposite side of the bet. I buy some stock in it, and they can reverse quite quickly with a lot. They're very volatile, but they can reverse quite quickly to the upside if oil goes higher. And what we saw was a very huge revaluation of oil higher in terms of ratio. We went from 50 to 25. And in terms of oil price, oil is one of the greatest inflation hedges. If oil is a good inflation hedge, that means debt can be inflated away. So this is just one of the areas that I play, is a highly leveraged, which is a highly indebted company that has a lot of debt in oil, because one, they're going to be pennies on the dollar when you buy them, and which means very huge upsides. Two, if it's a high cost producer, they're not making money, but if oil comes back above the cost of that producer, the break-even point, their margins explode to many multiples, many multiples. It could be 100 times more, depending on how high the price of oil goes. So I favor them because, one, they're the best value, but they're risky. And two, they usually give the best returns if they don't go bankrupt. So that's why I really manage my portfolio allocation to them. The more leveraged companies gives you the most leveraged returns. So if you buy at bottoms and you were lucky enough to get it very close to a bottom, you could 100 times your money. I'm not saying that they all do that, but there's some that potentially could. If you get a little bit of money in there, even if it's, let's say you put $1,000 in there, that could go into $100,000, return, or 1,000 could turn into 100,000 on 100x return. Some of them, they might go more than 100x. It depends how beat down they got, and it depends how high oil goes, if it's an oil company. So I prefer those just because if I'm going to hit the risk button, I'm going to do a full send risk on some of my money. And if I can't beat the physical metals, I just buy the physical metal then. Andy, can you tell when you entered the different stocks you show? This would assist people here to understand what you considered to be entering value on your side. It looks like you entered them pretty cheap and they look pricey now. Well, I did enter them cheap. The valuations were very good. I entered a lot of these things in 2020 in October, like September, October, November timeframe. And I've been riding them the entire time. And I've been cost averaging into my favorite companies that I still think are cheap because the ratios are cheap. They're not pricey because your valuations on your ratios are cheap, and ratios are used everywhere. It's everyday pricing. When you benchmark a house against another house, that's really a ratio. You're just trying to see, is this a one-to-one relationship? If everything matches, it should be roughly the same price. We do it with price to earnings, price to book, price to sales. Those are all ratios. Everything we use in life is basically ratios. So don't be afraid when I say ratios. It's just a valuation metric. But yes, I did buy lower than where we are today, some substantially lower. Some like SM Energy, I bought at $1.50 is my cost basis. CDEV was very cheap. But I still think they are of good value. Now, I know people look at the short term, they see things go up and down. I feel it too sometimes. It just depends on the day, how emotional someone is and what mood they're in. But going up and down, I'm not too bothered by it. Some people, they're a lot more connected to their money. And most of the time, you kind of have to disconnect from your money. I know the hard work that everyone puts in to make their money. But when I look at these things, I look at it as part ownership of a company and having those assets there. And I want to partake in that asset and have exposure to it because I believe that these commodities are going to go higher at some point. We know that they're cheap. That is a fact. The ratios are cheap. I've used ratios for many, many years. That's about the most reliable indicator in terms of knowing value. The problem is it doesn't give you timing. And timing is why we look at the technical analysis stuff. Technical analysis isn't perfect either. So it's really 60% accurate on the short term. And again, you can maybe get a little bit of the direction right, but it could reverse for any reason on the short term, news or anything. But overall, the big structural move is created from demand and supply balances along with the valuation of the dollar. The valuation of the dollar is a huge component in commodity pricing. So if you want to be involved and monitor your investments in commodities, you need to watch the dollar. Another way is if you want to diversify your portfolio, you can have commodities as a section of it, and then you could have something that offsets the dollar. Basically, you could have stocks or something like that, because when the dollar goes up, people then prefer dollar-based assets. You get equity exposure plus a strengthening dollar, and if they're priced in dollars, you get that double whammy. Now, when the dollar goes down, it's the exact opposite, and it favors something like an emerging markets or something that's foreign, like a Canadian market or Australian market, and commodities. Commodities do well in a weakening dollar environment. In the short term, the dollar's been relatively stable. It's been going sideways. It's neither good or bad for commodities, and you're seeing commodities go sideways as well. When the dollar, if we're going into a commodity boom, the dollar has to weaken. I don't think we can have a commodity boom with a strengthening dollar. I don't think I've seen it before, but a weakening dollar, yes. Now, what causes the dollar to weaken? It is inflation, and if they hold interest rates low, they buy it with quantitative easing, all of the pressure should mount at the value of the dollar. But the dollar hasn't fallen yet, and I think a lot of people are kind of dumbfounded, even myself, that the dollar has not fallen lower yet. And we understand that the dollar is based off of, it's priced against a bunch of other, a basket of other currencies. And that, I don't know if that's really necessarily a great one, but whenever the dollar is weaker than that basket of currencies and it starts to go lower in the index, like DXY, that's when we see a commodity boom, because that'll shift the preference of ownership out of dollar-based assets and into non-dollar-based assets, which precious metals, commodities, and foreign emerging markets, foreign markets do very well in those conditions. So that's why I'm looking at all this stuff all the time. I still think that dollar weakness is usually paired with an expansion phase of real estate. It's inflationary, and that's when I see dollar weakness. That's when I see the index go down. So that's why I'm still a bull, because real estate is still strong. If you lose real estate, then we gotta shift. But real estate's still strong, so we hold. That's the way that I view it. So I'm in it to hold on. If the U.S. government is going to spend over $1 trillion on infrastructure, would it be a smart move to invest in stocks related to infrastructure? Yeah, that's why I put some money into solar. I think some of that money is going to spill into renewables, but yeah, infrastructure is a good bet if they pass all this stuff. But it depends. Yeah, it's a good bet. It'd be a good bet. But I usually don't bet based off of just money going in stimulus money, because they get to choose where it goes. That's the difficult part. It's not like the free market's choosing these things. What I really like, if I had a total alignment, which I think we do, is and why I like commodities so much, is that if your timing's wrong, you got the valuation behind you. It's right there. You know you're buying this stuff cheap. And when you can buy these things cheap, I think that's a good spot to be. And I know some of this stuff's going to take time, and I know you guys, if you're in it, your senior accounts, it went way up in the beginning on the channel, and then now it's coming back in this first kind of pullback that we're seeing in commodities. And another thing that I'll share with you is investing is rough if you're trying to do this for the long term, because the moves to the upside are violent and short. And then you go in these large consolidation patterns where it chops sideways for a while. And you could see the choppiness of the downward movement or consolidation pattern that is twice as long as the up move. So you're going to be in consolidation patterns potentially in the beginning of some of these bull markets for a little while before they just go berserk. And it's more about a patience and waiting game and being positioned than it is about getting too impatient and selling out. But that's whatever you guys want to do. I'm in the camp where I want to buy what's very cheap, and then I just wait for those conditions to change. And sometimes it takes a while for that to happen. For palladium, I bought that very cheap. It was going all over the place. I wrote it down in 2009, and I was buying in the mid 2000s. So I bought it in the mid 2000s. I wrote it down in 2009. I bought more. I was in it for probably 3, 4, 5 years, and then it just took off big time. Because it was in the ripe market conditions. We were in a real estate recovery phase, and that's when palladium usually does very well. And now in an expansion phase, I would say that it's probably going to end pretty soon and start heading lower. That's when our gold, silver, and platinum stocks do well. So it's about just sitting, unfortunately. Investing's like a long plane ride. It's not necessarily fun. You just kind of sit there, and if you don't really pay attention to it, it's not too bad. Trying to look at some more. Eric makes a comment. You need a new ratio, Bitcoin to X ratio. I'm going to tell you this. Bitcoin has crushed absolutely everything. Doesn't even matter what X is. It's beaten absolutely everything. Bitcoin has been the best investment in terms of historical returns. The question is that going to be true going forward? I don't know. And I wouldn't speculate on it this second. I still think it's going to pull back and go down because of the chart pattern. I think we're in a consolidation phase for Bitcoin. And the consolidation phase is going to last, I don't know, maybe 6 months to 2 years, something like that, longer. Now, when that bottoms, and if you guys have the conviction to go long in Bitcoin, I would be buying it at that time. I'll definitely share with everyone on the channel when that time might be. But right now, the difficult thing with Bitcoin, I don't know how to value it. So whenever I go into a lot of these investments, I've got I call it like air cover, like if you're going to go to war, I want planes and stuff, I want to be protected from above and people, getting getting smoked from my side, top down. But I don't know that I don't have that air cover with Bitcoin. All you've got is your technical analysis chart, and that's it. And it seems like everybody just trades based off the technical analysis of charts, and there's a lot of retail in it. At least that's what I think there is. And retail is usually wrong. And that's where I'm like, oh God, I mean, it's tough to, it's a tough one. But if the chart looks really, really good, I'll let you guys know. I think we still have more time to carve out a consolidation time. So I think it's possible it gets below or around 30,000 again. But that's me, and it could even go below it. I don't know. I'd like to see what the pattern is and where we're at that time, but I don't think we're just going to go higher. That's just me looking at patterns and all the charts I've seen. So, but that's all I've got for today, guys. Thanks for your comments and questions. Continue to leave them. I'll answer them if I see that it provides value for everyone on the channel. Please give me a thumbs up, subscribe to the channel if you haven't, and thank you for listening. This is Finding Value.